Our dearest audience, welcome to another episode of the Markets Talk Show, brought to you by Bahrain Bourse. I'm Noorhan AlZann, and in this episode, we're going to be discussing a topic that could be on the backseat of capital markets, but is extremely important for its functioning and its day-to-day operations: investor relations, market making, and liquidity provision. We'll be understanding how companies communicate with their investors, how liquidity is created and sustained, and how markets price and how they maintain that stability. In today's episode, I'm pleased to be joined by my guest, Mr. Paolo Casamassima, the Executive Director, Investment Relations and Stakeholder Engagement at Arqaam Capital, one of the leading investment banks in the region. Paolo is the former CEO of the Middle East Investor Relations Association and currently sits on the board of the Gulf Capital Markets Association. Paolo, it's extremely lovely to have you with us today. Thank you for joining us.
Noorhan, thank you for having me, and thank you, Bahrain Bourse, for having me today.
One of the most important functions in the industry right now, which is investor relations. But we hear a lot of buzzwords again about investor relations. So I want to understand, what is it? What is investor relations as a function? And for a market like GCC and Bahrain, why does it play an integral role?
Investor relations is a strategic function that connects a publicly listed company, say for example Aluminium Bahrain or National Bank of Bahrain, with the capital markets. It's a function responsible for translating the strategy of the company, the financial performances of the company, the risks and the governance of the company into a credible and communicatable equity story. Essentially, you are an investor relation officer, you are communicating with the markets, with the investors, and you're trying to make sure that your equity story is understood and that investors are buying into your company. In markets like Bahrain or smaller markets similar to Bahrain, the investor relation function can be the single most important determining factor between trading at a discount or a premium valuation. So essentially, whether a stock, to say it in simple terms, it's cheap or trading at a fair value or is expensive.
That's very valuable, actually. So when you talk to me that investor relations can effectively impact the price of a company's stock, so that means me as a retail investor, I should be interested in what's happening with investor relations.
Absolutely. So one of the things I always worry when there is a publicly listed company is when there is actually not an investor relation officer in place, or there is no dedicated function or a contact that you can reach out to ask from more difficult things, or simply, hey, when are dividends getting paid? So you as a retail, you can watch out to what's being communicated from the company. Usually the investor relation officer or the investor relation teams are responsible, and you can keep an eye on your investment to make sure that actually your investment is performing.
So investor relations acts like a bridge between the investor and the company?
Absolutely.
And in
100%.
that sense, I also, as a retail investor, can kind of reach out to them to better understand what's happening with the news?
You can, of course. There are, of course, a number of channels where the investor relation officer will communicate. There is an investor relation website where the key information are disclosed, and you can reach out to essentially gather information on information that are already public. If information are not public about the company, usually this happens before the earnings results, so the quarterly announcements, this is close period. And in that close period, the investor relation officer usually will not communicate anything unless it's already out in the market.
Okay, so it's a wonderful start for the episode, because now I know that as a retail investor, I can reach out to investor relations to get more information with publicly available information.
Of course.
I'm listening to an expert to you now, and if you were looking at an issuer's investor relations program and you were assessing what would be key performance indicators or what makes their program strong, what would you point out?
So you as an investor relation officer, you should have a good understanding of your shareholder base. So of course it's difficult to understand if you have, let's say, 50,000 shareholders, you will not be able to know all of them. But usually you want to keep a good understanding on your top holders. So top 50, top 100, top 250. You want to understand who is buying, who is selling, and try to also understand the reasons why this is happening. A good investor relation officer will try to create a good balance between local investors and international investors to keep the flow of capital coming foreign investment coming to the stock. And also you want to keep a good balance between institutional investors, so the pension funds, the sovereign wealth funds, and the retail investors. Now, retail investors, by nature, they trade significantly less.
Yeah.
So
less in terms of amounts, you mean?
Less in terms of amount, but also in terms of frequency. You are, as a retail investor, most retail investors will have less financial information, less access to data compared to institutional investors. So they will tend to make long-term investments. They will park them in their pension, and it's unlikely that they will trade on a quarterly basis or even annual basis in some cases. So if you, as a company, you go IPO and for some reason you end up, say, appointing investment banks that will only bring retail investors, then your stock will become illiquid, which is something that we'll touch base.
Right. So then investor relations ties in very well with liquidity, which I'm glad we're going to be covering later today.
Yeah.
But then you pointed out a couple of strong points, right? What would make an investor relations program strong? But what could be weaknesses that perhaps we can see in issuances, especially if we're focusing on the GCC? Is there anything that stands out as a weakness or an area that could be improved?
So there are a number of weaknesses. So first of all, the investor relations officer is responsible for disclosure. So you can perform very good in your disclosure and you can perform very bad. So first and foremost, companies that are public, they usually disclose on a quarterly basis. So an investor, whether institutional or retail, will see a red flag if all of a sudden the disclosures are stopping or you're missing one quarter. Usually, especially in this part of the world, it means bad news. There is a excessive amount of communication when things go well, and things tend to slow down when there is an issue. A good investor relations officer will make sure that you are communicating in good times and bad times with the same consistency. Same metrics. So if you have disclosed, for example, 25 KPIs for your performances, you will not drop to 20 in the next quarter. You will keep the same 25.
So it will be sustained irrespective of the company's performance. But that then highlights an important point. What is the role of an exchange when it comes to monitoring those companies and their issuances to ensure that consistency? Obviously, the company is going to have an IR officer who's going to ensure as much as possible. But what's the role of the exchange within this? Additionally, how do they play a role without over-regulating companies?
Well, the over-regulation and compliance theater is a bit of a risk because sometimes exchanges try to make a change and make a positive change to the market, but they end up over-regulating the market, which for an issuer becomes even more difficult. In fact, many listed companies, when they go from being private to being public, obviously they will have to start reporting on a regular basis, and there is a lot of compliance, a lot of extra costs. So you don't want to create unnecessary burden to the company, but you want to give certain guidance together with examples of best practices that will help issuers understand what are the requirements. And also, I would say, for exchanges, it's a good practice when there is a new regulation in place to start with soft guidance or recommendations, which then will be implemented at a later stage. This is something that was done in Bahrain when the mandatory ESG disclosures was put into place. They started with soft regulations, and then slowly they started to implement the practice with a firm deadline.
So we're seeing a lot of responsibility on the company and the issuer side by having internally their own efforts with investor relations. But we're also seeing a lot of guidance coming from the exchanges, which is well received to be able to have the disclosures that we need without over-regulating. Now I have a question that came to mind when you were speaking. If I'm a retail investor and maybe I don't have access to all the data to be able to make me understand if a company is valued correctly, especially that we're seeing a lot of IPOs in the region, how can I assess the credibility of the data that I'm seeing? Or what would be things that I should put in mind to know that this valuation or this pricing is actually accurate?
Well, for a retail investor, it can be quite difficult, in all honesty. But first of all, usually a good investor relation officer will have a good relationship with what we call sell-side houses, so investment banks that produce research on a specific company. So usually, not in all cases, but usually a company will have some piece of research that will be available and that will be able to circulate to the retail investor to read on the company. A company can also put the target prices that the banks are producing on a specific company on their website. So you can immediately go, if you're planning to make an investment in a company, you can go to the company website. In the investor relations section, there is usually analyst coverage section. In that section, you will see what's the guidance on the company, and hopefully the company has good coverage. If the company has poor coverage or no coverage, it doesn't mean that the company is bad, but it's a red flag in the sense that if there is no coverage, that means less people know about the company.
Right.
If less people know about the company, how can the share price go up?
Help me walk through this. If the company was going like they're going to list to go public, then the first step that I need to know if I wanted to get into this listing would be that I would go on the website and I'd see if they have any publications
Actually,
of their
no.
own.
If the company is going public, there will be no research published before the company goes public. There will just be a prospectus on the IPO, which is usually a 600-page document, which as a retail investor, you cannot read. Although, of course, you can put it in ChatGPT and ChatGPT can summarize it for you. But what happens is that later on, the banks that are placing the company public, that they're working on the transaction, they will start to publish research. And hopefully they will continue to publish research on the company.
I'm really glad you took us to the point of research, because we see a lot of research being published, right? And some of the research that's being published is sponsored research, which in my understanding, the company that is having the research is paying for it.
Yes.
Basically, put simply. So from your perspective, how important is sponsored research? And as for me, how can I trust that thin line between the data inside the report being credible and the fact that it's being paid for it? And might I add that I read a lot of this research, and I know that a lot of the institutions that issue it are very reputable organizations, but for us to understand that sensitive part.
So, first of all, why sponsored research happens? Let's start from that point. Some companies, for one reason or another, after they are public, they have no research. Sometimes the research coverage is dropped. And usually, first of all, how do banks that produce research make money on the research is by the equity sales team and the brokers of the company trading the stock. So that means that there are investors that are interested in the company, and therefore those investors are in trading, they're making commissions for the bank. So if you're producing research and you know that your equity sales team is trading the stock, you know that they are making money on behalf of the bank with commissions, and so it is worth producing research. When there is not enough trading, and unfortunately in this region, not Bahrain, just the Middle East, GCC, there are a number of names, 300, 400 names that almost have no trading on a daily basis, right? They may trade $100 sometimes, or zero volume. Of course, it's very difficult to make money for investment banks, and it doesn't justify the time that you would require for an analyst to research the company inside out and do all the financial models. However, what happens that perhaps the company says, well, yes, we don't have research, and this could be, again, different reasons. Perhaps we didn't have a good equity story. We are planning a transformational journey. We have a new strategy, and we want people to start knowing about us. And we want to start publishing about us, regardless of numbers being good or bad. But through the publication, we will show the change in our performances. So this is, first of all, one of the reasons why companies use research.
Paolo, I think part of the conversation that we were just having on research lighted up something really important, which we actually want to dive in deeply in this episode. You mentioned that some companies might have very little trading on them. Maybe they would go for months with very small amounts of trades. So that then takes me to a very great segue of liquidity provision and market making, right? Again, two key terms in the investment industry that we hear a lot. So I want to make sure that I understand them fully when you're here. What is liquidity provision and what is market making as a concept?
Perfect. Let me also take one step back to understand them fully. Let's give background to the audience, especially for the retail investors. So imagine you're a publicly listed company and you're going public, pre-IPO, now you're public. Let's say you have 100 shares. The company goes public and the largest shareholder or the largest shareholders decide to put a certain amount of shares in the market. They will put 10 shares. out of 100. The company will therefore have a free float of 10%. 10% will be the amount of shares traded on the stock exchange. Now, what happens that if those shares are not trading, even that 10%, and the largest shareholder is not trading because they are the strategic holder and they don't want to trade, there is no liquidity. So you, going back to the investor relation officer, you can be the best investor relation officer in town, but if there are no shares on the stock exchange to trade, who's going to buy the stock? And you can go out on the road and meet investors, and your investors can be incredibly excited about your story. However, they want to build a position. Now, institutional investors, for example, they want to build positions. Usually, they will not touch anything that has below $1 million daily trading volume. So imagine you are trying to bring capital from abroad, for example. You want to bring a large investor, a BlackRock or a sovereign wealth fund, nor just bank or Templeton. They will not look at you unless actually you have at least $5 million or $10 million trading volume, right? So depending on the type of investor relation function that you want to have, and depending on how open you are with the market, you will decide your free float, as well as whether you will have a liquidity provider or not in place. Let's go to liquidity provision, market makers. First of all, what they do. Essentially, what they do, they ensure that there is a constant bid of ask and sell. So there is always demand in the market.
So there's always a buyer and a seller for that
Correct.
equity.
Correct.
And the liquidity provider, let's say if it was Arqaam, it would always make sure that there was a buyer and a seller for the stock.
Correct. Now, the difference is actually in the model and the incentives that are used. So usually the market maker trades with his own capital. The market maker will, yes, provide a bid for ask, will buy and sell bid. And then if they lose money, they will bear the losses. How they are incentivized to do so, it's usually with certain incentives that are provided by the stock exchange, sometimes also by the company, by the listed company, but legally it's the bank that will bear the losses if there are losses, and they will trade with their own capital.
But if it's market making, they're the buyer for the seller and they're the seller for the buyer.
Yes, they will buy the stock and they will sell the stock. So for example, they will see that there is a buyer perhaps there at wanted to buy at 101 and the current price is 100, so they may buy a little bit at 100 and they will reoffer it at 1.01 and then there will be a sell at 99.99, and there will be, so essentially if you are an outsider, you will know that there is somebody there buying or selling. And if you want to buy, you don't feel that if tomorrow you need to sell, because let's say you're a retail investor and you want to sell because you have an emergency, you want to have the confidence that you can actually sell those shares because somebody will be there buying it.
Okay, so that's actually giving me a very critical function, especially in maybe volatile and smaller markets. So if there was no market maker in a particular market or a liquidity provider, would I feel the difference?
Yes. So first of all, say you are trading, you have an app. As a retail investor, you see, again, let's just say the price is 100 and then you go and trade, however, and you cannot trade for 100. You cannot buy at 100 because there is no liquidity. So to buy, you may have to pay 102 or 103. If there is a liquidity provider, you will be able to buy at 100.05, for example, or 100.010. There are other things that happen, so it's called slippage. So the price that you see on screen is actually not the real price that you end up paying, right? It's almost like, if we want to bring it back to retail investors, it's you say the gas for the transactions that you pay in buying and selling a crypto, or it's the buy and sell percentage that will be charged by the token that you're trading. That's the slippage. So sometimes there is a price, but actually when you go and trade it, it's a different price.
So it helps me find a seller if I want to buy. That's
Yes.
what it helps me do. But additionally, because we covered this before in previous episodes, it helps with the bid-ask spread, right?
Correct.
Because it makes it almost more affordable for me to be playing in the market.
Yes.
Okay.
Now, there is also another couple of factors. It's price gaps. So a small order, if there is very little liquidity, can actually move the market a lot, right? So a small purchase, let's not say just by a retail investor, but a small institutional investor making a small investment in relative terms could move the share price a lot because there is no one.
So there would be a lot of price swings.
Exactly. There is a lot of price swing. And for you, especially as a retail investor, it makes, in general, a person quite uncomfortable, right? Well, in general, everyone is uncomfortable with stocks that have a lot of volatility, but even more so the retail investor.
That's amazing. So it's such an important function just for market stability in its
Absolutely.
own. But I understand that institutional players would find this a lot valuable, but I can start to see a lot of value that a retail investor can get just by how the market dynamic is becoming more safe for me to enter and to play. If, again, I looked back at the example of IPOs and I was looking at a company and its valuation, or I'm looking at the concept of cost of capital, like how costly is capital in a particular market. Liquidity provision and market making, then how does it interplay with those? How does it help it?
Okay, so first of all, liquidity provision or market maker, they help the price discovery phase during an IPO. So sometimes you see during an IPO there is a lot of price swings if there is no liquidity provider or price stabilizer factor in place. So that first of all helps. It helps to stabilize the spreads. It reduces, especially in times of an IPO, sometimes you see those peak and then share price drops. So if there is a liquidity provider, market maker in place, usually those fluctuations are much smaller than that. Now, in terms of how it helps a company reducing the cost of capital, back to the point that if there is no liquidity, the price that you see on screen may not be the real one. So if a stock is not liquid and you are a publicly listed company and you want to use your shares as collateral, which means you want to borrow money from a bank using your stock as the collateral, right? So the bank assumes that if things go wrong, they will be able to force you to sell those shares and immediately they can recoup the loan that they have given you. In a market that is not liquid, this cannot happen because you will not be able to sell a big chunk of shares quickly in the market to pay off that loan. And that's also for you as a retail investor, right? As a retail investor, you can do the so-called Lombard loans. So you can own shares and then you can get a loan against the shares to use for your daily needs, for example. If there is no liquidity and the liquidity is very little, those loans are more expensive. And the cost of capital for the company, if they are borrowing money, for example, for an M&A, it will be higher.
I love this. So you're saying if I have a portfolio of stocks as a retail investor and I hold a portfolio of stocks and let's say for some reason I need to borrow some money,
yes,
then I potentially can collateralize my equity holdings and borrow against it. And having a liquid market allows me to do that, to borrow against my... So I don't need to sell or liquidate my equity portfolio.
Yes.
I could borrow against it. But for a lender to give that to me at the right interest rate or the right value, the market has to be liquid to allow me actually to collateralize my equity.
The market or your portfolio, right? So you could have a portfolio with very liquid names, and then you could have 50% of your portfolio with stocks that are completely illiquid. And you will be unlikely to be able to borrow against those shares.
I'm starting to see a lot of odd value that could probably come up, especially in volatile markets, or if there was some sort of a, God forbid, market crisis or something, then the role of liquidity provision, market making, and investor relations will really, really become essentially important. What would be your views on that?
Well, the only thing I will say is that when the right incentives are not in place for the market makers, for example, or for the liquidity provider, in periods of extreme volatility, they will disappear. So together, the volatility will also disappear. So if you are trying to to sell your stock, right, in a period of extreme volatility, but the liquidity provider or the market maker are not incentivized to do so, then also you will be unable to sell when you need to sell.
But what do you mean by incentivized? The fact that they come in a volatile market, what could make them incentivized to stay in?
Well, there will be certain KPIs that are set in place within a framework agreement. And those KPIs need to ensure that, for example, there is an ongoing bid and ask in the market. If there is no specific criteria to regulate that process, when the market becomes too risky, let's say when Trump makes an announcement in the news or oil prices are dropping, then the liquidity provider or the market maker can decide to stay out of the market.
I want you to put yourself in my shoes as a retail investor. I'm looking at a new IPO, and through the episodes of the Markets Talk Show, our audience has been learning how to invest. They've been learning how to assess investments. So I'm looking at a new issuance, whether it's an IPO or a stock that I'm interested in. Tell me, if you were in my shoes, what would you do to assess if this is a good investment for me to get into?
One of the first things that I would do is to look at the business quality, financial quality of the company, which means, is the business resilient? So are they operating within a sector that is currently going very well and you can foresee 10, 20 more years for that sector? Financial stability, which means, is the cash flow steady, or can you see hiccups in the revenues of the company? If there are perhaps excessive one-off items, this could be a red flag sometimes. Then governance, super important. So is management and people beyond management incentivized for the company to perform well? So usually if you have CEO, CFO, and some key employees holding shares in the company, then you know that your key men are there to stay, right? And they will support the company throughout the IPO journey and beyond. Then need to try and understand the valuation as much as you can, although of course may be difficult for a retail investor. And I would say usually try not to trade on the IPO day, because as a retail investor it's very volatile. So sometimes the share price can move 20% within the day. So you could be selling at the wrong time, or again buying at the wrong time. So
you're talking about a lot of fundamental analysis. I understand the company, I understand its governance structure, I try to see that it's kind of resilient and here to stay. And since you're an expert in this field, are there any reports or maybe areas that you think I should be reading consistently so I could stay updated, not just with the company, but also the market? So the core function is that I want to try to protect my portfolio as much as possible. So any reports, any readings, any sources that you think would be valuable to us in 2026?
So obviously there is a lot of news out there. There are plenty, probably too many. But stay updated in terms of what's happening with the macro. It's extremely important, especially at the moment. There are certain geopolitical risks in place and forex risk as well. So depending on what's happening in a particular time, you may have seen IPOs being postponed or cancelled. Usually it's because the macro is not favorable to that particular IPO, right, to the sector. There is forex risk, to currency risk, right? Yeah. So if a company is operating only in one country, you only have that forex of that country. If they are operating across multiple countries and perhaps they are operating in emerging markets, frontier markets, then the forex risk could be higher. That could be something to keep an eye out, and that could be a little riskier, right? You need to look at how the company discloses earnings consistency, investor relations, earnings consistency. I would say in general, keep an eye out on what's happening in that particular country in terms of the political and geopolitical of that country and what the exchange is doing. So an exchange that is working very proactively to improve the environment for the publicly listed companies, it's a good sign, and you know that positive things will happen. So let's just take the example of Saudi Arabia, for example. The exchange is doing a lot of positive things to incentivize the market. Just last week or 2 weeks ago, they have announced the removal of caps for foreign investors, right? So that's a huge sign, because you know that there will be billions of flow of capital that can now enter freely Saudi Arabia and can potentially push the prices up. The same is happening in neighboring countries. So for example, let's say in Oman, the stock exchange has enforced investor relation guidance, dividend policies to ensure that companies can communicate their dividend in a clear manner to investors, right? So then a company that is complying with those regulations is a company that is a good investment. If you see that the company is not complying with certain things, again, this could be a red flag for you as a retail investor.
So your guidance for us in 2026 is to focus macro, look at the markets, look at how they're operating, and if we're zooming in into a country, look at that country and how it's going. Then if I'm zooming in on that investment, I look at the regulator and what the regulator is doing, and then I zoom in on the company to see how well the company is resilient and able to keep up with the market.
Correct. Yes.
Okay. And hopefully I'll be able to protect our portfolio in 2026.
Hopefully. Maybe one final thing is that usually companies that have little debt or no debt, usually they will tend to pay dividends, or they may decide to deploy cash for acquisitions. And acquisitions usually will be a big driver for a share price to go up, right? Because you will increase the size of a company, you will increase the revenues of the company, and therefore you will increase the multiple. Sometimes companies that have debt, it doesn't mean that if they have high debt, of course, if they have a high debt ratio to revenues or to the overall value of the company, of course, that's a red flag. But some companies, they have debt that has been used to expand, but then they have clear repayment plans in place, right? So to reduce the overall debt exposure of that issuer, and that's a positive.
Okay, so I actually can read the company reports or even the publications to see their plans as well. So it's not just enough to see how strong the company is, but to see their plans for the future. If there are plans to expand, that could be a positive, but also how are they financing their scale?
Usually you will find those information in the quarterly results of the company. There will be sections of that report that are focused on management discussion analysis, and where management will be discussing the plans or perhaps justifying certain results and giving forward-looking guidance.
Wonderful. Paolo, it's been such an incredible time speaking with you today. I have built a very clear understanding, and I hope my audience will do as well. We now have a very solid understanding of investor relations, liquidity provision, and market making, and how they interplay so beautifully within the investment space to be able to facilitate price stability, price discovery, but more really importantly, to retain investor confidence in the markets. I want to thank you so much for joining us today and for taking the time to be on the Market Stock Show.
Thanks again for having me.
Thank you. Our dearest audience, we hope that you found today's episode informative and engaging. There's a lot for us to learn today, and we are so excited for you to join us on this learning experience. As always, this was the Market Stock Show, brought to you by Bahrain Bourse. Stay informed, stay invested. We'll see you next time.